Revenge trading is a huge pitfall for beginners who want to trade in the markets. Whether it's stocks, commodities, crypto, or any other entity, new traders often lean on their emotions and beliefs, thinking they've made the right call in the market. However, their biases and poor market analyses are usually inaccurate, causing the market to move against them. The result? Significant losses, often larger than their initial investments. So what exactly is revenge trading? Revenge trading occurs when you try to recoup losses by opening larger positions. In simple words, you're trying to get revenge for your previous losses. This tactic leads you to make constant, irrational decisions. You stop considering your trade sizes and inevitably you suffer major losses. The desire to recover becomes so strong it leads to poor risk management decisions. Let's look at an example. Our friend Trader X is ready to conquer the markets. After a quick analysis, he decides to buy a stock. Needless to say, he overlooks the stock's long-term trend, fails to evaluate the market conditions correctly, and doesn't notice the company's decreasing assets. Even though the company lacks a long-term investment plan, he believes the prices will go up. His wife warns him not to risk their savings, but he convinces her to let him invest $100. The stock price is $10. Our friend buys 10 shares, expecting the price to rise. Several hours after the market opens, prices start to drop significantly. The price falls to $9 and his wife convinces him to withdraw. He loses $10 and has a sleepless night. The next day, the price drops even lower to $8. Undeterred, Trader X is ready for revenge. He plans to buy 20 shares for $160 and sell when the price reaches $9 again, thereby making a $20 profit. With his wife away, he risks more money and buys 20 shares at $8 per share. The next day, the market opens again. Unfortunately for Trader X, the market keeps dropping. The price now is $7. Not only did he lose his initial $10, but now he's lost an additional $20 as well. Let's just say his wife wasn't happy when she found out. Revenge trading is one of the most common mistakes that new traders make. It's crucial to risk consistent amounts per trade, no matter how foolproof you think your analysis might be. Poor money management decisions can lead to quitting really fast, but that's why we are here. If you found this video helpful and want to learn more about trading, remember to hit the like button, share it with others who might benefit, and subscribe to our channel. We've got a lot more valuable tips and insights coming up in our future videos. Your journey to successful trading starts here with Financial Paradox. Don't miss out and subscribe now. We hope you enjoyed this video, and remember, successful trading involves calculated risk, not reckless revenge.